Good morning, and thank you for the opportunity to share some essential theories and concepts associated with interest rates, bond pricing, and analysis involved in building and maintaining a bond portfolio. As we progress through the PowerPoint presentation, I will discuss term structure, pricing of bonds, the calculation of the bond yield, how bond prices adjust across time for premium, par, and discount bonds, interest rate risk, and duration. We will also investigate the Treasury bond yield curve concept, theories to explain its shape, and how these theories can be helpful for successful bond investing. We will evaluate interest rate risk in the context of bond investing and potential risk management strategies. Finally, we will view bonds through the concept of duration for bond portfolio analysis, price risk measurement value for the duration, and how duration can measure the dynamics of price and reinvestment rate risk across time for a bond portfolio. My goal in this presentation is to leave you with a better understanding of the complexity of bond investing, bond portfolio management, and its relationship to the risk versus reward equation and liquidity management to ensure appropriate levels of working capital availability while a component of our firm's cash is waiting to be deployed. The principle of asset pricing, according to Shea, is that the market value of an asset at the present time must be equal to the present value of expected cash flows from the asset. Corporations and governments usually issue corporate and government bonds in $1,000 increments like the Figure 1 sample Macy's bond. $1,000 represents the par or face value of the bond and is paid to the investor plus the final coupon payment when the bond reaches its maturity date, which is usually 10 years or longer from the issue date if the bond is held to maturity. The coupon or interest rate is printed on the face of the bonds, and in this case is 8%. The frequency of coupon payments is listed as July 15th and January 15th of each year for the Macy's bond, and the semi-annual payments would be $40 since $1,000 multiplied by 8% is $80, and 80 divided by 2 is 40. I will use annual payments in this presentation instead of semi-annual remittances for simplification. Two critical dates appear on the bond: the issue date, January 15th, 1974, and the due or maturity date, January 15th, 1982, which results in the bond's term of 8 years. The capital asset pricing model, or CAPM, can calculate an asset's market interest rate. For CAPM, R is the required rate of return, RF is the nominal risk-free rate, which is the United States 10-year Treasury bond yield, or interest rate. RM minus RF is the difference between the required rate of return on the market portfolio and the risk-free rate for the period. In practice, the market portfolio is the return on Standard & Poor's 500 index. RM minus RF is called the market risk premium and must be positive. The market risk premium changes over time based on investor optimism or pessimism about the economic outlook. Pessimism equals more aversion to risk with an MRP closer to 10%, and optimism equals less risk aversion with an MRP closer to 3%. Beta is the market risk index of an asset. If the beta of an asset is 1, it means that if the value of the market portfolio goes up or down by 1%, the asset's value is likely to go up or down by 1%. For example, if the beta of an asset is 0.5, it means that if the value of the market portfolio goes up or down by 1%, the asset value is likely to go down or up by 0.5%. In Figure 2, you can see that only changes in beta, the market risk index, change the CAPM derived interest rate from the required market return rate, with a beta of 1 not changing the interest rate from the market necessary return rate. When we adjust the beta to 1.5, the interest rate jumps from 12% to 16.5%, and when we reduce the beta to 0.75, the interest rate drops from the 12% to 9.75%. There are different calculations of bond yield depending on whether the bond is held to maturity, which is the rate of return from receiving its agreed upon cash flows, its yield to maturity, or YTM, in comparison to the holding period yield, which depends on how long the bond is held and the price of the bond when it is sold. Figure 3 shows the market price relationship for a bond with a $1,000 face value, a 12% coupon rate, and a maturity of 7 years. If the market price is $850, then the yield to maturity is 15.29%. If the market price is the same as the face value of the bond, then the coupon rate is equal to the yield to maturity of 12%. If the market price is $1,020, then the yield to maturity is 11.6%. Recent research indicates that if the Purchasing Managers Index, or PMI, and the Gross Domestic Product, or GDP, increase, the risk of corporate bonds decreases and the interest rate spread of corporate bonds will decrease. If PMI declines, the economy is not developing well and corporate yield spreads will increase. In other words, if industrial product prices increase, industrial costs increase, resulting in higher default risk, higher risk premiums required from investors, and corporate bond yield spreads increasing. When a foreign currency of a major trading partner depreciates against the US dollar, then exports decrease and US corporate bond default rates increase. Figure 4 shows how bond prices adjust over time for premium, par, and discount bonds, all with face values of $1,000 and 25-year maturities in the absence of market interest rate changes, and all returns being able to be reinvested at the coupon rate. The blue line shows a premium bond where the bond price is higher than the face value of the bond. In this example, the coupon rate is 12%. However, the market requires a rate of return of 10% for a similar quality bond when it is initially issued. Based on the principle of asset pricing from slide 2, the premium price for the premium bond is $1,181.54 when it is issued and depreciates to its par value of $1,000 over the 25 years to maturity. The par bond's price equals its face value of $1,000 over the 25 years to maturity because in this case, the coupon rate is 12% and the required market return is 12% when the bond is issued through its maturity, so the bond face value of $1,000 does not change. For the discount bond, with a coupon rate of 12%, the investors required a 14% return from similar bonds when the bond was issued, which generated an issue value of $862.54, which is less than the face value of $1,000. As you can see, the discount bond appreciates until it matures at face value of $1,000. Next, we look at an evaluation of the yield curve and the theories to explain the shape. The yield curve exhibits the relationship between the interest rate and the year to maturity. Figure 5 shows the U.S. Department of the Treasury daily par yield rates on November 6, 2020 for short term, the 1 month at 0.1%, 2 month at 0.1%, 3 month at 0.1%, 6 month at 0.11%, and 1 year at 0.12%, and long term, 2 year at 0.16%, 3 year at 0.21%, 5 year at 0.36%, 7 year at 0.59%, 10 year at 0.83%, 20 year at 1.37%, and 30-year maturity at 1.6%, and appears to reflect the liquidity preference hypothesis. John Maynard Keynes' liquidity preference hypothesis suggests that in the interest rate markets, investors tend to prefer short-term securities to long-term ones because short-term securities are more liquid by being easier and faster to convert to cash. Their prices are less sensitive to interest rate fluctuation, which results in interest rate risk, than the longer-term securities, as we shall see. In response, investors require a premium to hold long-term securities, resulting in the long-term rates being generally higher than short rates. This hypothesis anticipates a rising slope yield curve under normal economic conditions. An upward sloping Treasury yield curve also suggests that investors have positive market expectations and less concern about downward pressure on interest rates. According to Shea, the expectations hypothesis is a theory that posits that the long-term interest rate is the geometric average of current and future in-year interest rates expected to prevail over the life of the issue. An upward sloping yield curve represents rising interest rates climbing in the future, while a downward sloping curve suggests interest rates dropping in the future. Interest rates are typically elevated during an economic expansion and diminish with a decelerating or shrinking economy. For investors, an upward trending yield curve may telegraph positive market expectations, while a declining yield curve may portend economic turbulence. Figure 6 depicts an inverted yield curve of the U.S. Department of the Treasury daily par yields on November 8, 2022, and appears to reflect investor optimism peaks at 2 years, with investor pessimism increasing and bottoming out in year 10, then improving to year 20, and then dropping until year 30, indicating predictions of further softening of the economy. The segmented market hypothesis suggests that bond market players would choose to act in the sector, either short, intermediate, or long maturity market, where they have the most significant knowledge and proficiency and limit their focus to the segment. The result, according to the theory, is that supply and demand determine the interest rates in each component. The supply and demand nature of this theory does not generate a specific shape of the yield curve. The liquidity preference, the expectations, and the segmented market hypotheses have been used to generate predictions and theories that can be helpful in bond investing by providing insight into general investor decision making, resulting in systems for delivering optimal risk versus return, passive and active strategies. Passive strategies for bond investing and portfolio management include immunization, buy and hold, and indexing. A firm is immunized if the duration of the assets is equal to that of the liabilities. The result is that for a given change in the interest rate, the impact on the value of the assets is identical to that of the financial obligations, and the cash generated from liquidating the assets would need to cover imminent commitments. For the strategy to be effective, the manager needs to rebalance the asset portfolio regularly. After an interest rate change, the duration of the assets may not equal the duration of the liabilities, requiring the manager to modify the asset composition to realign the durations of the investments and the liabilities. Even if the interest rate does not change, the duration of an asset or a liability will not remain the same due to the passage of time. As time passes, the duration decreases slower than the maturity. Even if the assets and the liabilities are duration matched initially, the durations of the assets and the liabilities may decline at different rates, and portfolio rebalancing would need to be completed to bring the durations together. Immunization can be seen in a buy and hold strategy where an investor chooses bonds with various maturities, coupon rates, credit levels, etc., with a plan to hold the bonds to maturity if needed. The weighted average duration of the bonds is calculated to be near when the funds will be required to reduce exposure to interest rate risk. So how could this work in practice? Imagine that you hold a bond portfolio that is expected to provide a total payback of $2 million to pay for your dream Bugatti sports car in 4 years. In this situation, the investment horizon is 4 years. The investment asset is the bond portfolio, and the liability is the payback to you of $2 million. The bonds may have various coupon rates, interest rates, and maturities, with some longer and some shorter than 4 years, but the weighted average duration is close to 4 years because you will need the cash in 4 years. Since there is only a single payment, the duration equals maturity. During the 4 years, all of the received coupon payments from the bonds must be reinvested to the end of the year 4 in something with risk like that of the bond. If the maturity of the bond is shorter than 4 years, the received par value when the bond matures must also be reinvested to the end of the year 4 on something with risk like that of the bond. If the maturity is longer than 4 years, the bond will be sold at the end of year 4 at the market prices at that time. The total payback should be as close to $2 million at the end of year 4, regardless of changes in interest rate in the interim. As long as you rebalance the portfolio from time to time to ensure duration matching between the asset and the liability to ensure that the investment project is immunized. Indexing is a strategy where investors build a bond portfolio that performs like a fixed income index instead of creating their buy and hold portfolios piecemeal. The portfolio is often evaluated by how closely it mirrors the index. Shea posits that the tracking error is measured by the standard deviation of the difference between the realized return of the portfolio and the realized return of the index. Active strategies for bond investing and portfolio management include valuation analysis, credit analysis, intersector yield spread swaps, substitution swap, and interest rate anticipation swaps. With valuation analysis, the characteristics of a bond are used to determine its intrinsic value, and the bond is bought if the inherent value is above the market price. If it is below the underlying value, the bond will be ignored or sold short. For the bonds deemed undervalued, long positions are taken with overvalued bonds receiving potentially short stances. A credit analysis strategy buys bonds with predictable rating upgrades by rating agencies to maintain long positions and retain short positions on bonds with potential rating downgrades. To predict a rating change, the investor will evaluate the internal conditions of the issuer of the bond as well as the general economic environment. During economic expansions, the default risk of a bond may be reduced even if the issuer is not in good financial health. In an unstable economic ecosystem, even a robust enterprise may be challenged with high fiscal unpredictability. With an intersector yield spread swap, investors assume a normal relationship exists between the yields and interest rates of two bond sectors, like between corporate and government bonds, between the long-term government and the short-term government bonds, between the low-grade and high-grade industrial bonds, etc. Spreads tend to increase during periods of significant turbulence and contraction and decrease during expansion cycles. Sometimes spreads are considered excessively broad or compressed in relation to the economic conditions, encouraging investors to execute bond swaps to lock in capital gains. The investors will gain if the yield spread narrows back to normal, meaning that the yield of the corporate bond goes down and the price goes up, and that the government bond goes up and the price goes down. For a substitution swap strategy, if two bonds have virtually the same coupon, credit quality, maturity, etc., but one bond has a higher yield than the other, investors will buy the bond with the higher yield to substitute for the one with the lower yield in their portfolio. The spread in yield is viewed as profit-taking opportunity since there appears to be an error in pricing. In other words, if you own Walmart's 20-year bond with an 8% coupon that is priced to yield 9%, and you find that Costco's bond with the same maturity and coupon is yielding 9.5%, you may sell the Walmart bond and use the proceeds to buy the Costco's bond if you perceive both are comparable replacements. You anticipate the distance to shrink or evaporate with the Walmart bond yield improving and price declining, and the Costco's bond yield shrinking and price increasing. The interest rate anticipation swap strategy requires the investor to correctly predict the direction of interest rate movement to preserve capital when interest rates are rising and to produce attractive capital gains when interest rates are falling. If higher interest rates are predicted, the investor rearranges his portfolio to where it has a shorter duration to reduce the capital loss if interest rates increase. If lower interest rates are expected, you will rebalance your portfolio to a longer duration to support the financial return if interest rates subside as estimated. Interest rate risk for bond investments can appear in several forms, one of which is where bonds are not maturing when future payment obligations appear. To provide additional liquidity to pay unforeseen liabilities, bonds may need to be sold before the bond's maturity date. Bonds are then sold at the price that the market is currently paying for the bonds with similar characteristics, and the interest rates at that time may be higher than the coupon rate of the bonds. Figure 7 demonstrates that in a situation where two bonds are the same in every way apart from the time to maturity, the price of the longer-term bond is more sensitive to the variances in interest rates than the shorter-term bond. In other words, the longer-term bond will have higher interest rate risk. Bonds A and B have the same coupon rate and par value, but A has 30 years to maturity and B has 5 years to maturity. When RD is 8%, equal to the coupon rate, the price of both bonds is $1,000, equal to the par value. If RD increases to 10%, the price of both bonds drops, but the price of bond A falls more than bond B. If RD increases to 6%, the price of both bonds goes up, but the price of bond A increases more than bond B. In summary, the price of the longer-term bond is more sensitive to changes in interest rates than that of the shorter bond. In other words, the future selling price of the longer bond is more unpredictable. Duration price risk refers to the potential for the bondholder to sell a bond with a lower coupon rate than the market is willing to buy at the lower rate due to market interest rates being higher, and the result is the sale at a discounted price below the par rate. According to Shea, duration of a bond portfolio is equal to the weighted average of the durations of the bonds in the portfolio, and the weight is equal to the value of the bond divided by the total value of the portfolio. A firm has its excess cash invested in a bond portfolio that is expected to generate cash flows to meet future payments of the firm's liabilities. We see in Figure 8 how price risk can be measured in a bond portfolio with the examples of 3 bonds. Bond A has a market price of $1,000, a coupon rate of 8%, and a duration of 6 years. Bond B has a market price of $900, an interest rate of 9%, and a duration of 4%. Bond C has a market price of $1,100, a coupon rate of 7%, and a duration of 7 years. The weighted average interest rate of these 3 bonds is 7.9333% and has a portfolio duration of 5.7667%. Based on the information available, the interest rate risk can be expressed as a 1% drop in the market interest rate that would increase the portfolio value by approximately $160.28. The concept of duration measures sensitivity to interest rate changes. Since rates offered for bonds can change at any time depending on investor confidence in the industry, changes in bond ratings for an issuing company or government by major credit rating agencies such as Standard & Poor's and Moody's, legislative actions, and changing perceptions of the direction of the economy. As we have seen, interest rate changes for bonds do not tend to spike up or down quickly, so there is less probability of significant increases or decreases in the short term. However, rates that rise in the short term can increase yield spreads as time progresses, so longer duration bonds are exposed to broader price change exposure for longer duration maturities than for shorter duration maturities. Figure 9 shows a 3-year time to maturity bond with a face value of $1,000 and an 80% coupon rate paid annually at $80 per year, and a bond price of $1,081.70. By calculating the weighted averages of the discounted cash flows, we arrive at a duration for the bond of 2.792 years. The change in price if the market interest rate is 6% instead of the coupon rate of 8% results in a bond price of $1,053.46 and a loss in value of $28.24. That loss increases to $28.76 based on the duration of 2.792. If interest rates decrease to 4%, then the bond price would increase to $1,111, which is a $29.31 increase in price and a $28.76 increase in price based on duration. Reinvestment rate risk increases over time for a bond portfolio due to bonds reaching their maturity date and redeeming. And with callable bonds, which allow for early payoff without penalty based on providing a higher than market coupon rate for the option, or bonds simply paying off early. Figure 10 compares the potential cost of early payoff in year 3 of a bond with a 30-year maturity, a coupon rate of 12%, and an annual coupon payment of $120. The remaining coupon payments at 12% total $3,240 over the remaining 27 years if the bond does not pay off early. If the market rate for a bond with similar characteristics at the end of year 3 was purchased at a 10% coupon rate instead of the 12% rate, then the loss in income for the remaining 27 years would be approximately $540. If the coupon rate were 8%, then when the bond was redeemed, then the loss in income increases to $1,080. If the market rate is 6%, then the remaining 27 coupon payments result in a loss of half of the remaining payments on the original bond for a loss of $1,620. This is the end of my presentation on bonds and bond investing. Thank you for your interest, and I hope that the information presented answers all of the questions that you might have had before the presentation. Please feel free to ask me any questions that you might have moving forward.